Okay, welcome everybody. I'm glad everyone's excited to learn about trust today. My name is Christine Roberts. I'm the Executive Director at the Nebraska United Methodist Foundation. And today we're excited to have Matt McKeever here to present to us a little bit on the ins and outs of trust and what they can do for your church and congregation members. First and foremost, please, if you haven't already, mute yourself or I will mute you. But Matt will do his presentation. I'll say a few words and then we'll have a chance for questions and answers towards the end today. And so Matt, if you want to take it away, have at it.
Thanks, Christine. Yeah, I'm Matt McKeever. I'm an attorney in Omaha. I work with Burnett Wilson Law, and I'm in my 26th year practice. I've been a lifelong Methodist. I grew up in Norfolk, actually, and was part of the Norfolk United Methodist Church with my parents and my sister there. Back in 2002, I married an Omaha native, was married at Elkhorn Hills, and presently I'm a member of Elkhorn Hills Methodist Church. And then for the last couple decade or more, I've been a member at Maplewood United Methodist Church, about 102nd and Maple in Omaha. And been on the various committees, SPRC, all that, and enjoyed working with the church. But at the same time, over the years, I've also been fortunate enough to be able to give people advice when they come in and are doing some estate planning. They want to know how they can do charitable donations. And sometimes it's very straightforward. They just put it in their will. But other times they want to do something else that might have either some tax advantages for them or tax advantages for the church or both. And at the same time, the church gets a charitable donation, sometimes larger than what would have been had they just simply given the money straight to the church or given the assets straight to the church. So I've been doing a lot of planning over the years for that. And it's about a quarter of my practice is estate and business planning. I've been working with these issues quite a bit over the years, most recently even regarding digital assets. And for example, if you transfer an online stock or even digital currency like Bitcoin, what are the advantages of doing that when you make a charitable donation to a church with those assets? So that's pretty much what I've been doing for the most. I was admitted to practice 26 years ago. That's been a quarter of my practice. The other part of my practice has been estate and probate, and then also estate and probate litigation and trust litigation. And oftentimes that's fixing things that have gone wrong in other trusts or other probate. So I've learned to prevent those problems in the estate planning documents. And what's really good about these types of trusts that we'll be talking about today, they're very well established. They've been around a long time, and they're very useful for helping out the church. And we can also talk about today how we can involve the Methodist Foundation here in Nebraska to help you execute those plans. So without any further ado, as they say, what I will do is call up a share screen, and we can start sharing my screen. Can everyone see my screen? It's the introductory screen.
Yes.
Okay. Good. So we'll
Matthew, who is your father?
Oh, I'm sorry, I couldn't hear you.
Matthew, who is your father?
Oh, my father's Ron McKeever. Ron and Dottie McKeever in Norfolk.
Know him well.
Okay, yes, okay. Yeah, they haven't been strangers up in Norfolk or the community. You see them at Camp Fontenelle a lot. He's been on the board for quite a while. So good. Well, for my introduction, I've kind of already done my introduction, I suppose. So here's just an outline about me very briefly, and we've kind of talked about that. So I went to UNL for undergrad, went to New York for my law degree, had the good sense to come home. And like I said, a lot of what I've been doing now is estate and business planning. What we'll be talking about today primarily is, of course, trusts and charitable trusts and how to use those trusts in any estate planning you or members of your congregation would want to use to help out charities, either your church or charities related to the church. And so for a brief overview, we're going to go over the advantages of, well, first of all, charitable giving generally, the tax advantages, the donations and types of assets, and then doing a bequest and a will. These are just kind of straightforward solutions. They're not the main topic of our conversation today. What we'll be mainly talking about would be 5 through 11, which is charitable trusts generally, things called charitable remainder trusts or CRTs, charitable lead trusts called CLTs, and then life insurance trusts. Those are actually usually called ILITs, or that's an abbreviation for those. And then some other types of trusts that are less common but might be useful for you or members of your congregation. And then we'll leave it open to some questions too. So first of all, let's go over, and maybe you're already familiar with this, so I don't want to hash over ground that you're already really familiar with, but really there are many advantages to charitable giving, whether directly or through a bequest and a will or through a trust. For example, you can support the institution you choose. We've all, of course, heard about number 4, the income tax deduction. Well, there's some certain thresholds for that. That might not be your primary motive to give, but there are some advantages to that. And also when you give, you might be able to avoid or minimize capital gains taxes. We'll go into that a little bit too. That could be that could be quite a bit, whether it be long-term or short-term capital gains taxes when you donate an asset. Donations of personal property items like decluttering are also important items. Sometimes you just, what's in your basement, you just donate it to the church, or maybe they have a rummage sale at your church. Well, there are deductions for that, and there are advantages to that. And it might also be an alternative to any volunteering. So basically, we all know you want to support your church. There are a lot of advantages to charitable giving. The advantages work both ways. The tax advantages of charitable giving, of course, are income tax deductions. You have to give what you are giving. Your gift has to go to an IRS 501c3 charity. Your church is a 501c3 charity. The Nebraska United Methodist Foundation is a 501c3 charity. There are a lot of charities, or it doesn't necessarily, when we're talking about trusts, oftentimes there can be types of trusts that don't necessarily rely on 501c3s, but to be sure to get the tax deduction, you can check on the IRS website to be sure whoever you're donating to is a charity. And there are limits and certain organizations, and that's in a particular IRS publication. That's one of those details we don't necessarily have to go into right now, but it's just an issue for you to know. Something to consider also is the recent tax laws. Back about 4 years ago, we changed how we had thresholds for charitable giving. Before, you got a tax deduction if you gave to a charity. Now there are standard deductions, and so you need to make sure that you have altogether your standard deductions are more than a threshold that allow you to get that tax deduction. So, and I have this list here. It's basically your single, it's about over 13,000, almost 14,000. If you're head of a household, it's 21,000. For a lot of us, it'll be close to 27,700 for married filing jointly. So, and one way to make sure you get those deductions, you can bunch donations, and that's usually at the end of the year. You might have a lot of money to give. You give some on January 1st, and then at December 1st, you put maybe everything you're going to give the next year, and you put it in the same year as the donations you gave earlier in the year. And so altogether, maybe it was 2 years worth of donations, but you get the tax benefit in the current year. Whereas you might not have received a tax benefit in either year had you not bunched up your donations like that all in 1 year. Capital gains taxes, especially when it comes to charities, that's a really big advantage. No one likes them. No one likes capital gains taxes, but they are part of the process. So what you do, you can plan for that by making sure you donate assets correctly. And maybe we're all familiar with this already. Let's say we give out some stocks to our church. We want to make sure we don't cash them out first. We don't sell the stocks, because then we incur capital gains. Even if you put stocks in your estate may have to sell those and then give to the church. And again, capital gains taxes would then be realized by your estate. So you don't necessarily want to do that. what you want to do is you want to give that asset, whether it be a stock or car or real estate, you just want to outright give that to, as it is, without cashing it out, to a church, or the United Methodist Foundation can help you with that, because they can receive assets that perhaps your church is not able to do. So for example, if I went to Maplewood United Methodist Church and said, here's $1,000 in stock, there you go. They wouldn't have the means to really manage that or sell it or anything. They would probably prefer the United Methodist Foundation here in Nebraska take that, because they have the ability to take the stock as a charitable organization, cash it out, and then give that money to the church. And that way you get what's called stepped up basis, or actually there is no basis because it's a charitable donation and you don't pay any capital gains or other taxes on the charitable donation. So if you had an asset, let's say you bought the stocks for $1,000 and now they're worth $2,000. If you cashed them out, you pay capital gains on that $1,000 gain. If you just give them to the foundation to cash out and give to your church, there are no capital gains taxes. You may have saved $300 on that $1,000 gain or more. So there are some advantages to charitable giving and making sure you do it in the right way that will help you avoid capital gains taxes. There are also inheritance taxes, which in the United States, if you have a threshold, it's $11.65 million or almost $23 million between a couple, then that's where we're looking at United States inheritance taxes. That's a great problem to have if you have it. But if you don't have that problem, you probably are not, having $23 million on hand to worry about where it's going to go. You probably don't need any sophisticated tax planning in your state for that. But what you might want to consider too in planning for taxes, that Nebraska does have an inheritance tax. It's not big for people that you're giving to if they are direct descendants of you, but for distant relatives, it could be a lot. Now, direct descendants still pay 1% after the first $100,000 they're given. The more people you give to, the more kiddos you have, for example, the more deductions you get. So each person that you give to that's a direct descendant has a $100,000 exemption. So the first $100,000 you give them is exempt from the taxation, but then it's 1% after that. So you give $5,000, or in this case, let's say you're going to give $110,000 to somebody, and they were a direct descendant, they were a kid, one of your kids, then the first $100,000 would be exempt from taxation. They would pay 1% on the $10,000 or $100. So that's how you want to consider things. And maybe you want to be, give as much as you can to as many people as you can to get all those exemptions. But when you're getting to more distant relatives or people who aren't either companies or friends, then they might be paying 15% after the first 25,000 you give them. And that can get pretty expensive. This money goes all to the county, and it's good to improve your county. I'm sure your county could use the money, but you could probably have the people that you want to give this to, they might need it more. That's kind of up to you. Again, federal estate tax deductions, that's a lot of money. Rates could be 18 to 40%, depending on your tax bracket. But again, there are a lot of ways, including issues regarding what's called portability, where one spouse can basically tack on to the $12.92 million exemption of the other spouse. So if that's a problem, hopefully that's not a problem having that much money, but if it is, then some more sophisticated tax planning might be warranted. And that could include charitable trusts and so forth. Gift taxes are also potentially a problem when you gift something to someone who is not a charity. If they are even a family member, even your child who's no longer in your household or over the age of 21, we might be looking at the potential for gift taxes. So in this year, any gifts you give to anyone over the age, basically they're not in your household, they're not your spouse. If it's over $17,000, you need to record that, and you need to, on your taxes, report your gifts. You have a lifetime exemption equal to this federal estate tax deduction where they aren't taxed, but you need to make sure that you record those gifts. And that's why a lot of people will just say, it's Christmas time, here's $17,000 per child. Here's a gift. And that way there's no gift tax liability to anybody, and they get the 17,000. So there are all types of gifts. You can have gifts of money, and I encourage you to keep those receipts and cancel checks in case the IRS wants you to justify your deduction. You can gift non-cash items. We talked about cars and stocks and real estate. And then there's a way to determine those values, and that's with the IRS publication here in the materials, 561 and 526. And I can make this PowerPoint available to any of you who request it. You could request it from me or Christine, and we can just send it to you. You can, of course, give people just direct, or the church for that matter, direct donation through your will. Or you know, and the example that I have here, it's Camp Fontenelle, because like I said, that's a project near and dear, especially to my parents' parents. And then also me, that's where I was confirmed, is Camp Fontenelle. So I enjoy going to that place and bringing my kids there too. So let's say you have something in your will saying, you know, pay my expenses and my funeral and things like pay my taxes, and for the residue of my estate, first pay $1,000 to Camp Fontenelle. Well, you get $1,000, your estate gets $1,000 deducted from its gross amount. And that much less is taxed. So there's some advantage to doing that. And the church, of course, gets that money as part of the will. So here's just an example. Just throwing that out there is you can use a donation in your will to perhaps lower a threshold so that you reach an exemption. In this case, Bob wants to donate. He figures out what his assets are and figures that a fixed amount donation in his will probably reduce his estate down. He has 4 children, so they each receive $100,000. By giving $250,000, everything's either been donated to the church or is covered by that $100,000 per direct descendant exemption, and he pays no Nebraska inheritance tax. So that'd be one way to use your will to help reduce or eliminate your tax liability. So charitable trusts are a very valuable alternative to just simply putting something in your will as a bequest. You can do a lot of things. A charitable trust can be very general. It can be for education or religion or health. So it's not necessarily something you have to do for the church. Our focus here today is for the United Methodist Church and your local church and the foundation, of course. But it's for any charitable purpose. And for charitable trusts, unlike a lot of other trusts that people set up for their families, there's no time limit. These things can last forever. You can make a bequest to your church that pays income to your church on the principle of a trust. So let's say you donate $10,000. You want the income that the trust has. Maybe it was invested. The funds are put in an investment account. Those funds could continue to fund your church as long as there's money to send. So it could go on potentially forever. So that's beyond what's called the rule of perpetuities, and that's 21 years past the life of someone living. So you could fund a project, you could fund education in your church, you could fund education in the district, for example. So it's very flexible and there's no time limit. Now, a trust, charitable trust or otherwise, needs a trustee, and that's someone who's managing the trust, who is familiar enough with some of the basic rules. Usually, a family member is good. You can have a law office. What's often common is to use a trust department. In this case, we have the benefit of what might be a free or reduced cost trust department in the Nebraska United Methodist Foundation, and Christine knows all about that, of course. They can provide many or all of the services, a trust that you create for charity that supports the church. They can provide the services that oftentimes a trust department or a financial manager would charge a fee to do. So, for example, a church scholarship fund could be administered by the Nebraska United Methodist Foundation, and there wouldn't be any fees necessarily for doing that. Whereupon, let's say you gave it to a bank trust account, a trust department, they would have a number of attorneys, they'd have overhead and other costs that they would charge to the trust. So if you used a trust department for that in a bank, for example, you would be winding up donating less than you would have. So one example of the use of a shareable trust, this is maybe the most basic type. They set up a trust with a principal investment of $200,000 to support the youth ministry in their local church. They get tax deductions for this. So the John and Julie are just the sample couple that we have here. And here in this case, they asked the Nebraska United Methodist Foundation to be the trustee and to administer the funds over the duration of the trust, as well as the trust could also receive the shares of stock. Oh, I'm sensing a video pause. We may have lost a connection.
Matt, I can still hear you just fine.
Can you see me as well?
I can see you as well.
Okay. My screen is frozen up for some reason, so.
That's unfortunate. Let me know if you have trouble with your PowerPoint. We're still seeing
Okay.
John and Julie on our screens.
Okay. Yeah. I'm all locked up on this end for some reason. I'm trying to change the screen to the next screen in the PowerPoint. It doesn't seem to want to work.
Okay, I will stop your share and I will share my screen
Okay,
and we'll see if that
that
can.
might clear it up.
Can't get through anything without some technical difficulties, right?
Yeah, I guess not. Yeah. So yeah, I'm not even seeing my mouse move on my end. So everything, all the pictures of the various people who are watching here today, they're all frozen for me and I can't seem to manipulate my screen.
Do you know what slide number that John and Julie was?
No, I did not number my
That's okay.
oh,
I
no,
found
it's
it.
number 16. I'm sorry. Yeah, it's slide
I
number 16.
Found it. Okay, and go ahead and.
Okay, let me try one more thing here.
Okay. Because now I can't see you.
Oh, okay.
FYI.
All right.
But we can still hear you.
Huh. That is odd.
I see him over to the side of the gallery view.
You see his picture?
Am I moving?
No, I can't tell whether that's picture, whether it's frozen or whether you've moved your head. Doesn't look like it's moving.
Matt, can you at least see your slides?
No, well, I can see just the last one. The others are just not available to me, it looks like.
Can you see my screen share?
I cannot see anything, it looks like. What I could do is if everyone wants to hang on and maybe.
Gonna sign off and come back? Well, clearly he must be because I can't hear him at all now.
Yes.
Okay, Kurt, you had a question.
Yes.
Yeah, so the church that I serve in Ogallala, we've got several endowments, and the way you've been kind of talking about trusts, they sound similar, or at least that seems as though that's how they're kind of set up similar. But what's the difference between a trust and an endowment? Christine says that they're not the same thing, even though they sound kind of similar. So
An endowment is usually a fund just set up for some sort of purpose and usually a charitable purpose. So
Okay.
it doesn't necessarily have to be a charity. It would be something, certainly if you have an endowment, it means you're basically setting up a fund for a particular purpose. Whereas, such as, it might be for youth ministry, it might be just to support the pastor, it might be to support pastor training. So you can have an endowment, and that could be also managed by the Methodist Church. So it's something, and it's oftentimes not limited to a single person's trust. It's something that a number of people can potentially donate to. So setting up an endowment is something that I know the foundation does. And then, for example, you could donate in your will to the endowment. You could set up your trust to help fund a number of charities, including an endowment. So endowment is just another vehicle for people to get together and support a charitable purpose.
Okay.
That's how I'd see it. So yeah, you might have an endowment, it would just be a fund that's been set up to whatever, to support the church. And people, it doesn't have to be necessarily the initial donor. It could be other people that contribute to it too, to support that particular function.
Whereas
What
a
do you-
trust, it's your thing. It's
Yes.
one individual thing.
Yeah.
Matt, do you have control over your PowerPoint, or did
I
you?
think so. I think what happened is my computer might have just gotten a little too hot under the collar and just locked up. So I made sure the fan is on, and I don't know. It just maybe summer's a little too early for this thing. So let me see if I can share the screen again. And there. How are we now? Can you see the PowerPoint?
Yes, it looks great.
Great.
We're still on John and Julie, though.
Yes, we're still on John and Julie. We hope everything works out well for them. I'm sure it will. So I appreciate everyone's patience with me and the technology. So I think we were just talking about how, yeah, you can receive a tax deduction for contributions, and the foundation can help John and Julie do that and realize the tax advantage of doing it. So there, we talk about charitable trusts generally. This is an example of a more specialized trust, but it's not really that complicated. You'll see things called charitable remainder trusts or charitable remainder unit trusts. They're basically trusts that are set up to do special things with the assets of the trust and take advantage of assets that produce income. So, and it's also usually referred to as a CRT for charitable remainder trust, or you might see it as CRUT for charitable remainder unit trust. There's not much difference between a unit trust and just a regular old trust. So usually I just call them CRTs. Anyway, what you do, you put assets in the trust and you receive the income. So for example, let's say you have rental property, you have dividend earning stock, you have some other investment. Some people in Nebraska and Western Nebraska might have oil and gas leases, for example, on property that they own. Whatever the case is, if it makes money, the core or essential asset can be donated, and whatever income that asset generates can continue to give you income. And you have the tax advantage of the value of the gift that you just donated is potentially tax deductible. So, but the asset is not actually transferred until the donor passes away, or in a case of a couple, it could be a second to die situation where both donors have passed and then the asset is passed on to charity. So there are some very good benefits. You get income from the asset you donated. You've lowered your estate taxes. You probably lowered your exposure to inheritance and estate taxes. You've given a guaranteed donation to a charity through the trust. And the charity may continue to enjoy that afterwards. It might be that the value of the asset, since it's managed by a trustee, maybe it's stocks and managed by a financial advisor, maybe it grows in value in addition to the income. So let's say you have rental income and you put a rental house into a charitable remainder trust. You get the rents from the house, but the house might increase from 300,000 to 400,000, and the church would get the benefit of that gain without it paying any capital gains taxes. So if it's going to lose money, well, that's still, the church still gets something anyway, but it's possible that it'll gain, and the church would realize the benefit of that. So here's an example of a charitable remainder trust. We're talking about Jack and Jill. They are thinking about moving into assisted living, and they have a house without any debt. And it's worth $500,000. They bought it for only $200,000. So if they were to sell it and give the proceeds to the church, they pay capital gains taxes on $300,000, and that would not be pretty. So Jack and Jill donate the house to a charitable remainder trust. The house is then sold, the proceed by the charity. In this case, it could be the Nebraska United Methodist Foundation, whatever the situation might be. It's put into the charitable remainder trust. The house is sold, the proceeds are invested, let's say invested in an index fund. So they get an annual income up to 5% of the trust assets each year as income, whatever the income was. And it's revalued on an annual basis. The IRS does take a look at this. They do potentially have the ability to audit the trust to make sure that it did not exceed legal limits as to what income you can draw. You can't draw on the principal of the trust. But when both Jack and Jill have passed away, then the trust assets are donated to the church. And again, the trust assets themselves may have appreciated in value. And here's a little illustration actually about how such a transaction would look like. You and step number 1 in the lower left, you transfer the assets to the charitable remainder trust. And so that a trustee takes control of them. You've lost control over those assets actually, but the trust is designed to guarantee you that income from the asset. So the proceeds are invested. The charitable remainder trust in step 3 pays you income for the length of the trust, which could be the length of your life, for example, or a couple for it's a second to die provision in the trust. And then step 4, at the end of the trust term, the remaining assets go to a charity. In this case, go to the church. So pretty simple, straightforward flow chart. You donate an asset, you keep the income off the asset, and you get the gain of a charitable donation, and the church gets the gain of a charitable donation that may have appreciated in value. So that's one time. It's a charitable remainder trust. I guess the key term is remainder. What's remaining of the trust is there gaining interest or gaining income for you. So kind of the reverse is a different kind of trust. It's a charitable lead trust. So instead of donating the asset and getting the income, you're donating an income and keeping the asset. So for this, you can have a charitable lead trust that allow you to donate assets in the trust before sending the proceeds on to charitable organizations. And what this does is you get a stream of income for a charity, and then the leftover assets remain tax-free, and you can give them to in your will to somebody or in the trust. When you pass away, then that asset passes to whomever you want in the trust, but the income of that asset went to your charity. So the reverse of the Jack and Jill scenario might be that they, instead of selling their house and getting the proceeds, they sell the house, the proceeds, then the income, instead of going to Jack and Jill, would go to the church. And then when Jack and Jill pass away, the principal of the trust that was invested goes to their children. So that's just kind of, like I said, a reverse of using, instead of keeping the income and giving the asset, you keep the asset and keep the income. So here's an example of how a charitable lead trust might work, where in this case, Alice wants to put $1 million in a 20-year charitable lead trust for her church. And the church is supposed to receive $50,000 each year as a donation through this trust. And then whatever left goes to her daughter, Barbara. So the IRS takes a look at that and says there'll probably be about $100,000 left of the asset at the end to go to Barbara. Now, it's possible there might be more money than the $100,000 or whatever. It might be that this worked out for Barbara because the asset really appreciated over those 20 years, and Barbara makes quite a bit of a windfall, and no tax might be due because the income was being used for a charitable purpose. So, but the reverse is true too. If the asset underperforms, if they put all that in a penny stock, or heaven forgive them if they put it into Bitcoin, whatever the situation might be, they might have had assets that underperform, and the heir of the estate might not get anything. This isn't as popular as the charitable remainder trust because there is some additional risk. We don't know what's going to happen to that asset over time. People usually prefer to give the asset and keep the income as opposed to the other way around. So just a quick illustration of how this would work. Step 1, the donor gives money to the lead trust. 2, the fixed yearly payments go to the church, and then the remainder goes to family or the next of kin after they pass away. So pretty straightforward 3-step trust, but again, not as popular as a remainder trust. Another very important area of trusts are life insurance trusts, where you create a trust that funds a life insurance policy those, if it's a charitable trust, those premium payments for the life insurance policy could be tax deductible and go to benefit the church through a second to die policy. It could be an individual policy or a second to die policy. So you're basically making your premiums tax deductible on that. And some whole life policies that you have for this, they may actually appreciate, and the assets that you use to store the cash value, in addition, the death benefit may be more than what you originally were planning on. The assets that fund the that are used for part of the whole life policy, the investments could have increased so that the death benefit is actually more than what you contracted for with the life insurance company. So that has a lot of advantages about, the church may wind up with more money than you thought. So depending on, so the idea is to live as long as possible too. So your whole life policy really pays off for the church that way. And each premium payment you make then is potentially tax deductible. Here's a quick example of a life insurance trust, or again, the abbreviation is ILIT and ILIT. So you have a grantor, the person who's giving, and they give through premium payments, and they pay the premium payments to the trust, who then actually is the one who pays the life insurance premium. The trustee is responsible to do that. This is something that it could be a family member, could be a trustee, but oftentimes you want a life insurance or their financial manager or even a law firm or trust department to be the trustee. So eventually the beneficiary is paid when the second to die policy, for example, if it's a whole life insurance policy with a $500,000 death benefit for a couple when they pass away, then the church would potentially receive $500,000, and the couple had received deductions for all of their premium payments on that. And again, let's say it was a $500,000 policy, but if their assets that were used to store the value of the whole life policy increased more than $500,000, then that's an added benefit for the church. So another way to consider charitable giving. There are some other trusts that might go into a little too much detail for us today. There are annuity trusts that you can set up. Those are oftentimes not necessarily set up for charities, but they could be. Some people use those as planning for Medicaid trusts, for example. But for the most part, we have an annuity trust is something that the principal goes to some sort of charitable organization. And then a unitrust has, that's another term of art that we use about payments being based on the percentage of the fair market value of the assets. And then custom trusts. There might be something that we haven't specifically discussed here. You can combine a charitable lead and a charitable remainder trust. They can do this, both things at the same time. You can have one trust doing 10 different things, funding 10 different charities. There's no real limit. The trust process is very flexible in what you want to do. And the law on this in Nebraska and nearly every other state is extremely well established. So if you set up a trust and you make your wishes very clear, and you have counsel that can plan those trusts for you, it's going to be followed and upheld. So here's an example of a unitrust. I don't want to delve into this too much, but this is one, it's a charitable remainder trust with lifetime payments to the person equal to 5% of the fair market value of the trust. So in this case, Alice puts in $500,000 and the beneficiary is her church. So she receives $25,000 the first year for the trust. Subsequent payments amount might be different because we're dealing with a percentage of the fair market value of what's in the trust. So she is eligible for an income tax deduction. That's adjusted. It's not necessarily the straightforward 500, but it's a lot, as you can see in this example. And that by itself might save her a lot of money in taxes and put her in a lower tax bracket as a result. This is something that is usually requires more management. It does require a financial professional, and you probably would want an accountant doing your taxes to make sure you take full advantage of this kind of trust. Here's just a quick example, a little illustration of Alice giving $500,000 to the trust. She gets $25,000 per year, and the rest goes to the church. Pretty straightforward. So that's basically an overview of charitable giving, and in particular charitable trusts. We have a lot of experience here at my firm. We have 7 lawyers that do a lot of estate and business planning, including these kind of trusts, and we'd be more than happy to help any of these 7 attorneys. You can, of course, use counsel local to your community. There are no restrictions. I would say most experienced estate planners would be very familiar with the tools that I've introduced you to today. They might have other tools as well. For example, people with more than the federal limits for inheritance taxes, we're talking about $25 million or more. There are other types of vehicles. There could be foundations, for example. There are a lot of other vehicles to use. But for the most part, I found these kinds of charitable trusts to be the most economical for the donor, and at the same time, very efficient and established. They're not so complicated that we need to spend a lot of money on administration. So that's why I usually prefer these types of charitable trusts. So that's all I had today. So I'll thank you, Christine. Thank you for everyone. I'll turn it over. I know, Christine, you have a number of things to say as well.
Are you able to stop your screen share?
Yes, I will do that.
Hello, everybody. I can see you again. First, for the benefit of the recording, I just want to make sure that generally anyone who views this knows that at least right now, the Nebraska United Methodist Foundation doesn't really have the capability to be a trustee. However, I will talk to our attorneys about that and see if that is a possibility. So keep your eyes open to the newsletters to keep you updated on that. And Matt, I just wanted to put out there into the world a general question for you to answer, a softball, I would say,
Okay.
is why would somebody want to do a trust rather than a will?
Yeah, well, that was to some extent outlined, and a will is very straightforward, and so there might be some advantages. It's a lot less expensive just to do it in the will, but if you use a trust, you can potentially get more of a deduction yourself and wind up giving more to the church or whatever charity that you have affiliated with the church. So generally a trust is just, and for example, if you just give it in your will, that's good. You don't necessarily see the benefit while you're alive. If you create like a charitable remainder trust, you can give that asset, get that deduction now when it might be more valuable for you, and still get the income off of that asset. So a trust allows you to do a number of things that otherwise just a straight will could not do.
And there's privacy to a will, to a trust rather than a will. Is that true?
That's right. That's another advantage of a trust, is that you don't necessarily have to let everyone in the world know what the provisions of the trust are. You don't have to file the trust necessarily. You can file it with your local county court if you wish to do so, or if there's a need. But most of the time, nearly all the time, there's no need to do that. And sometimes, for example, there might be a Nebraska inheritance tax calculation when the donor of the trust has passed away. And even then, the trust provisions are not known. They're not published. They're not filed with the court. An inheritance tax determination is just basically made a short form inventory of the assets that you had when you passed away. It needs to be filed one way or the other. But again, all your assets and certainly the terms of the trust are not public. They are basically confidential. And you do have to share them with the beneficiaries of the trust. If the church is a beneficiary, it would make sense for them, of course, to have a copy of the trust, and the trustee would be in communication. And you're right, Christine, it's not necessarily the United Methodist Church Foundation is not necessarily a trustee, but a trustee can work in conjunction with the foundation to accomplish those goals that otherwise without the foundation they couldn't get done. So for example, stock.
Yes. Perfect. I did say a little bit when there was the technical difficulty to the group here, and again, for the benefit of the recording, generally speaking, the foundation, we are here to help you to organize and help you get referrals to get these trusts set up if that's something that's going to work for you. Our services are free to all United Methodists across the state, and so we're happy to come meet with you and chat with what you would like your plans to be. We always say if after your children and your heirs are taken care of, what would excite you about your estate planning? What would you want to leave to your favorite charity? So questions from anybody else? Dale, you unmuted. Did you have a question?
No, I didn't realize it.
Well, I mean, you don't have to mute yourself again. I just thought you were antsy to ask a question. Did anybody else have any questions? And it doesn't even have to be about trust if you do have any other random questions.
Like about who knows my dad? That sort of thing.
Anybody associated with Camp Fontenelle knows your dad.
Yeah, I suppose so.
This is Larry Ruth. Christine, I have a question, and it's only related to trust in the sense that it likewise deals with contributions to the church, but not necessarily to a trust. The question is this: qualified charitable distributions are becoming a more popular way of giving, and they're really wonderful, especially for those folks of us like ourselves who are getting older and getting, of course, the required minimum distributions back. And I think to many people it's almost like free money. You don't realize it, but you've got to take it, and you got to do something with it. And when you use a qualified distribution, you get the contribution, but you don't take it as a deduction. You get what you get is a reduction, but it's not treated as income, basically, like it would normally be treated as income. Do you have any thoughts on that, Matt, and how that can be, I wouldn't say marketed, but how that can be disclosed and educated to people? Because a lot of folks are getting required minimum distributions and are just taking it, and then they give a contribution to the church.
Yeah.
And that doesn't make any sense if they knew it. And are there any devices that you've talked about which in some way take advantage of qualified charitable distributions to further maximize the tax savings consequence?
Matt, before you dive too deeply into answering that question, Larry, I will say I do put that in as much marketing as I can. It's just a matter of like, I know I've put in a few newsletters in the last year and a half that I've been at the foundation. But if you get a newsletter once a month and you don't care to read it, then you haven't learned that part. And then I do try to make sure I talk about RMDs in my presentations when I go talk to churches when they invite me in. And so that's another way I'm trying to educate people that giving those RMDs to a charity rather than taking it for yourself and getting taxed on it is a major benefit. But Matt, go ahead and answer that a little bit better.
Okay. I don't know if I can answer it better, but yeah, we call it QCDs, or qualified charitable distributions. They are definitely a better way to go than cashing out and then contributing. You can actually, and I was just looking up some separate materials that I had from a seminar a while back about funding. You could fund a charitable trust with those qualified charitable distributions. You could, in addition to donating to the church, that could be part of your trust, your charitable trust plan. And in the examples that I have in this other material, you could do a charitable remainder trust. You could fund that trust with your qualified charitable distributions from an IRA, for example. You can set up an annuity. You can, or just do a straight charitable gift annuity that's initially funded by these qualified distributions. So there are a number of devices that you can use. If that answered, I think, your second part of your question, but yes, it's definitely an advantage, and I would encourage it. It wasn't a topic for our seminar, of course, today, but it could have been, I suppose, because yes, those QCDs can be used to fund some of the charitable trusts that we talked about.
So you have a requirement to take we'll say 100,000 in required minimum distribution, or 500 or 50,000 or whatever. And if
Yeah, I
you
think it's
funded it,
50.
if you, pardon me,
Yeah, I think there's a limit to as to 50.
uh, for
If you're
qualified
going to
charitable.
fund a charitable trust, that is, if you're going to fund
Oh,
a
okay,
charitable trust, there are
because-
limits to what you can do.
Yeah,
with-
because there is a limit on qualified charitable distributions, I believe also, but yeah, but in any event, then you get the advantage of not paying taxes on that part as income. And you would also, what would the rest of the advantage be? It would be the general advantage of having charitable trust.
Well, let's say you got your QCDs into a charitable remainder trust, and it keeps funding the trust or increasing the principal of the trust. That increases its income generation, increases its overall investment. Maybe the investment grows. So again, your money would be working for you,
Yeah.
and then increasing the overall amount you wind up donating to the church.
Yeah.
So you could do that. That would be one way to structure.
Yeah.
In a
And
charitable.
I might just say the holders of IRAs are doing a much better job of getting the checks out to the donors, either for direct distribution to the church, for example, or going direct from the holder to the church. And I think we're seeing some maturation in that area. It's becoming easier to do qualified charitable distributions. It used to be pretty difficult.
Yeah.
Thank you.
Yeah, the law changes almost annually on that too. So it's sometimes difficult to stay at the forefront of that. So
I wanted to add to your vehicles you mentioned there in that list for the required minimum distributions, Matt, a donor advised fund.
Yeah.
Would be an option too, where then you could recommend the beneficiaries of those funds to a charitable purpose. Okay, does anybody else have any other questions?
Question
Dan.
on that. I'm going to turn 70 and a half in a couple of months. I turned 70 in March. As I understand it, that required minimum distribution begins at that time, correct?
yeah.
Do they know I think I've got part of the pension is in a Roth IRA, if I understand correctly. Will they contact me to tell me that I'm going to have to take this? Or do they just send you a check automatically if you haven't told them not to? And how do we make a decision about that before we get the first check, so to speak, so before it comes to us? You understand my question, or am I
I
clear?
do, yes. And it might depend on your plan, since everyone's got a different plan administrator. If you're talking about getting notice ahead of time about when this will start, they usually do send out at least a letter anyway. If
Okay.
you're having annual conferences with the plan administrator, that's usually pretty common, is to have some sort of annual meeting. Maybe oftentimes that's while you're still in the workplace or something, but one way or the other, at least there's some annual contact, and then they will say, look, this is coming up. And at the very least, there is almost always, a notice of changes in your plan or distributions that they send out. But again, that's some companies administer plans better than others. So I don't know what your plan administrator does. You'd go to your account administrator and you can ask them these questions in advance and find out.
Okay.
Exactly. And either a customer service rep or probably a local representative if they're a major organization.
Okay.
And,
Probably the conference benefits officer. I'll try to talk to him at annual conference. Then, okay.
So,
Thank you.
Every plan is different. Some are better than others. So
Yes. Well, and one thing to realize also, when my mother passed away, she had property in Illinois, and every state's different. And so we didn't have Illinois doesn't have any inheritance tax on farm ground. So
Oh,
we didn't have to pay any inheritance tax in Illinois. And because it was in Illinois and not Nebraska, we avoided the tax here on that part of it.
I still love living in Nebraska, but yeah.
Oh, yeah.
sometimes other states make it Make it.
Oh, yeah.
difficult. For tax, yeah, that would be nice to have is that kind of exemption here.
Like you said, the county officers cry foul whenever the unicameral talks about it.
Yes.
Okay, well, it's a little past 1, so I'll thank everyone for coming to the webinar today. And if you need anything else, I'll send out the slides to everyone who is here. If anyone views this recording later and like the slides, please send me an email. But everyone have great days and stay in touch, please.
Christine and Matt, thank you very much.